Today, Educator breaks down the first batch of Q4 earnings reports, while digesting this week's much anticipated, the second of two inflation reports. First, we got some inflation-related, encouraging news. Wholesale price BPI unexpectedly fell 0.1% in December, for the third consecutive month of no growth. Similar trend to previous months. Commodity BPI declined. Energy and food prices were the main drivers. Services PPI remains stubborn. The data comes on the heels of yesterday's. The more widely watched consumer price data was released, which was released later. US PPI continues to cool, signaling a decline in inflation in the coming months. Today's PPI data confirms December's CPI pickup may have been a one-off. The Federal Reserve cuts interest rates, and slowing the pace of balance sheet reduction on the way continues to be clear. Backering markets digest more Fed rate cuts in 2024. However, recent statements from a number of Fed officials seem to refute the market's aggressive view. Two of the 2024 will have the right to vote at the Fed's Monetary Policy Committee (FOMC) meetings spoke on the same day. Both mentioned the latest CPI inflation data. Cleveland Union President Mester said, "The latest data reinforces his view. The Fed's fight against high inflation is not yet complete. Need to see more progress on housing, goods and services." Board of Governors Chairman Baldwin said, "Once inflation is on track toward the Fed's main target, 2%, he'll be open to cutting rates. He would be open to a rate cut," and reiterated, "Send someone to look for more evidence of inflation moving back toward 2%. Mester has been a staunch Fed hawk for the past 2 years. Has been a staunch big hawk at the Fed. He's had a vote on rate decisions this year. But in June of this year, Mester's term as president of the Cleveland Fed, Mester's term as president of the Cleveland Federation will come to an end, and he's expected to step down at that time." Here's a quick look at the earnings reports. Many big banks reported earnings. JP Morgan Chase, the financial giant. JP Morgan Chase, the financial giant, after its fourth quarter revenue beat estimates. Shares rose. At one point, it was at an all-time high. However, JP Morgan's earnings report for the October-December period, profits were down 15% from a year earlier. Reported a $2.9 billion charge due to last year's regional bank failures, and a $2.9 billion charge, resulting in a drop in fourth quarter profits. But it still had its most profitable year ever. Net profit for the year was a record $49 billion, at 10 times the price-earnings ratio. High interest rates add up. Earnings led bank stocks. Jimmy Dimon, JP Morgan Chase's chief financial officer, said, "Corporate and investment banking channels look strong, but uncertainty remains. As resistance to M&A remains, loss ratios are much lower than before." The Gate also warns about long-term trends in inflation and market expectations for interest rates. Due to great geopolitical uncertainty, JP Morgan will take a cautious approach in 2024. Bank of America reported a decline in fourth quarter earnings. Q4 net income down more than 50% year over year. Shares fell, earnings report shows. Bank of America last quarter to replenish the Federal Deposit Insurance Fund of the FDIC spent $2.1 billion, and as a result, net income fell. In addition, Bank of America disclosed that it plans to hold bonds to maturity. On bonds that it plans to hold to maturity, but still close to $100 billion, down from $131.6 billion in the third quarter. The decrease in book losses, mainly due to the bond market rally at the end of last year. If Bank of America had held these bonds to maturity, if Bank of America holds these bonds to maturity, the losses won't turn into real losses. But holding these bonds represents a large opportunity cost of not being able to invest at higher interest rates or lend money, but the results are generally solid. There will be fewer headwinds this year, corresponding to a win ratio of roughly 9x as well, despite revenues exceeding expectations. High profits beats analysts' expectations for cost cutting, but Wells Fargo's share still fell. Wells Fargo warned net interest income could fall 7% to 9% in 2024. The reserve for credit losses also increased 34% from $957 million a year ago. From $957 million a year ago to $1.28 billion. The bank said credit cards and commercial real estate loans allowance for credit losses increased, despite a low outlook for net interest income. But Wells Fargo said it expects to buy back more shares this year than in 2023. Currently, Wells Fargo is still operating under an asset cap, which prevents it from growing, until regulators believe the bank has resolved the fake account scandal that caused problems. The bank has been subject to 9 public consent orders from regulators, requiring additional oversight of its behavior, which is expected to take another year. BlackRock reported fourth quarter earnings that beat analyst estimates. In addition, the company raised its quarterly dividend, but also announced that it will acquire a global infrastructure partner for about $12 billion. After acquiring Global Infrastructure Partners, the deal is expected to close in the third quarter. Shares have retreated recently. BlackRock pulled out of China with a curse. It's not profitable to do so. Some resigned and returned to their hometowns. Some went into business and took the test. Maybe they are making money by shorting behind the scene. For the stock market this year, BlackRock is bullish on the financial markets and the US economy, and predicts that the S&P could end the year. By the end of the year, Citi took a loss on a series of charges. At the same time, the bank raised its provision to $1.28 billion to prepare for non-performing loans. The chief financial officer said that pressure on commercial real estate, centered on corporate office buildings across the country, office lending has been a concern. The rise of remote work has spurred more job openings, making it harder for owners to repay loans. The good news: Citi, after losing $1.8 billion in the fourth quarter, announced layoffs, Brazil said. As part of new corporate reforms, it will lay off 20,000 employees in the medium term, about 10% of its workforce. On its news, the stock rose instead of fell. Here's one more thing. Layoffs have now become a winning formula for earnings reports. Citi's layoffs, expected to save as much as $2.5 billion in costs. The prospect of savings helped mask Citi's poor fourth quarter performance. And that's not all. Eventually, by the end of 2026, Citi's overall workforce will be reduced by 60,000, down to 180,000 jobs. In fact, the last 3 months have been an anomaly on Wall Street, because historically, US companies have actually gone to great lengths to avoid laying off employees during the holiday season. The data shows January is the month with the most layoffs. The end of the year brings a wave of layoffs. Google has been exposed to reorganize the company's ad sales division. To reorganize the company's ad sales division on a large scale could put 30,000 employees at risk of layoff. Streaming platform Spotify also a few days ago announced 1,500 layoffs. A rival bank announced 1,500 layoffs. Hasbro, the century-old toy maker, announced more than 1,000 layoffs. Microsoft will lay off 10,000 employees worldwide by the end of March. Amazon also began on the same day, implementing its plan to cut 18,000 jobs, making it the largest layoff in the company's history. Intel will also be in California, eliminating hundreds of jobs. Silicon Valley's job cuts keep heating up. But clearly, by all accounts, the US economy is in pretty good shape. Unemployment is low, consumer support is solid, and wage growth is finally beating inflation. So why are US companies laying off workers on a massive scale? Or are the mass layoffs? Is it just an illusion? Most year-end layoffs are based on the assumption that a recession is imminent. The lack of future economic expectations is one reason, although there may not be evidence to support it. Misaligned expectations cause companies to scramble to boost annual profits in response to a sharp economic downturn. When companies report quarterly results, typically track their financial position to the calendar year. A company's annual report to shareholders is also important to attract new investors. So year-end layoffs, often to cut costs in a time of crisis, in order to beautify the company's balance sheet for the benefit of shareholders. The U.S. Treasury Department reports. The U.S. government budget for the first quarter of fiscal year 2024 totaled $510 billion, expanding 21% year-over-year. December alone saw $129.4 billion in spending, 52% higher than the same period a year earlier. The surge in the deficit was the first time total government debt exceeded $30 trillion, compared to the final deficit of $1.7 trillion a year earlier. Deficits will widen in 2024 at the current rate of deficit growth. Deficit at the end of 2024 will be slightly more than $2 trillion, despite assurances from the Biden administration that the Inflation Reduction Bill, in addition to lowering prices, would also reduce the deficit by hundreds of billions of dollars. But deficits continue to grow as the Fed raises interest rates to fight inflation. In 2023, the cost of financing the U.S. government totals nearly $660 billion. The numbers above look scary. But as long as U.S. debt sales are good, no one cares. The first ultra-long-term U.S. bond auction of the year. The U.S. Treasury Department auctioning $21 billion in 30-year Treasury bonds. It's the first ultra-long-term U.S. bond auction since 2024. The auction results were generally solid. Strong overseas demand as the receiver that takes on all the unpurchased supply. Primary dealers reported 14.5% for the round, the lowest since last August, confirming that real solid demand despite this solid auction of U.S. debt. But it's still a cautionary tale for the year as a whole, because the flood of new U.S. debt issuance is about to begin. Biden is going to issue a huge amount of debt just before the presidential election to stimulate the economy. And finally, the US spot Bitcoin ETF is off to a strong start. Let's look at the video posting for more details. It traded billions of dollars on its first day of trading. Previously, the Bitcoin ETF, one of the key reasons it wasn't approved was US regulation couldn't really regulate Bitcoin. But recently, a series of cryptocurrency exchanges, many of the big players have been taken into custody as well as turned themselves in, and technology has advanced, and tracking is now feasible. So the ICC finally stepped in to form a complete regulatory framework to regulate the spot market for participants in terms of security, because they don't hold Bitcoin. So you don't have to worry about hacking and other security issues, and save on storage costs. The current fee rate will be an important factor for investors. In choosing an ETF, there are several funds, such as Bit and Arc offer 0% fees, undoubtedly have strong competitiveness. Of course, there is a high probability that these 0 fees are temporary. They will be removed after a while. If the listed ETFs have high exposure, will attract investors looking for liquidity. Most of the current demand may come from fund finders prearranged, so-called seed funds, as more and more economic proprietary traders listing funds on their platforms. There may be signs of more organic demand, such as from retail investors, or demand from financial advisors. In short, it's predictable that in the future, there will be a lot of OTC money involved in this market. Bitcoin futures overlaid on a Bitcoin spot ETF, all under the supervision of the U.S. government. US dollar capital will have a dominant voice and influence in the pricing of Bitcoin. This is the end of the Bitcoin pricing war. That's it for this video. The US stock market is closed next Monday. The biggest fear these days is a geopolitical crisis. No news is the best news. Well, have a great weekend and a great vacation.